Good news from Switzerland. Despite many of its neighbouring economies faltering, the latest ZEW-Credit Suisse survey, which monitors analyst expectations for the coming 6 months, has moved into positive ground and continuing the bullish trend of recent months. This comes after the very same survey slumped in December. I'm delighted to welcome Lena Jaroszek from the German institute behind this survey. Lena, why has the survey experienced such a big turnaround since December?
The ZEW-Credit Suisse indicator reflects the expectations regarding the economic development in Switzerland on a 6-month time horizon. So this year's marked increase made for sight seems surprising, considering that Switzerland's economic growth in the last quarter of 2011 was close to zero, but it has to be stressed that circumstances were unfavorable due to various reasons: the euro crisis, a strong Swiss franc, and even the fear of a default of further financial institutions. So the marked increase of the indicator in this year's first quarter may be due to the fact that despite these issues, the Swiss economy succeeded to grow in 2011 at all and can therefore be said to be in good shape. Furthermore, the development of Switzerland's domestic economy is currently strongly influenced by central banks' policies. For instance, the European Central Bank applies an extremely expansive monetary policy in order to cope with the credit crisis. And in order to keep the relation between the euro and the Swiss franc stable, the Swiss National Bank follows this expansive monetary policy. But since Switzerland's domestic economy is in a healthy state, this monetary policy is too expansive. However, this expansive monetary policy does support Switzerland's domestic economy, especially consumption and construction, and therefore economic growth, and this is probably reflected in the ZEW-CS indicator.
How closely linked are Switzerland's fortunes to those in the Eurozone, and is Switzerland well insulated from a deep downturn in that bloc?
Well, since Switzerland's domestic market is small, exports play an important role. In 2011, exports accounted for 54% of Swiss GDP. And furthermore, Switzerland is connected to foreign countries via its large financial sector. Its economic situation is therefore in large parts linked to the economic developments abroad. And since Europe is Switzerland's main exporting market, the European credit crisis poses a severe threat, and further difficulties arise because of the Swiss franc's strength.
From the survey, what is the general feeling about the franc's 120 floor against the euro?
This exact issue was the focus of our last survey special question. We asked financial analysts about their expectations regarding the monetary policy of the SNB. The majority of the participants, that is 81%, do not expect change of the lower boundary within the next 6 months. This majority shrinks to about 2/3 of the respondents when asked for the expectations for the boundary in the next 6 to 12 months. However, only 5% expect the SNB to lower the floor. And by the way, this is pretty much in line with the analyst's exchange rate forecast for the next 6 months. A majority of them expect the currency relation to stay constant, while 1/3 expects the Swiss franc to depreciate versus the euro, and only less than 10% expect a stronger Swiss franc. This can be seen as a first indication that the SNB is pursuing a credible exchange rate policy. Another indication is given by our analyst inflation forecast for 2012 and 2013. They are minus 0.4 for this year and 0.5 for next year. We can see that they are quite in line with SNB's expectation. Since the SNB links its monetary policy to inflation expectations, and inflation expectations are low, the SNB can be expected to stick to its current policy. Currently, inflation and interest rates pose no risks for the currency peg, but they may in the more distant future. At present, this is difficult to assess and less relevant.
The survey results are positive, but what are the main downside risks to the Swiss economy?
As I have said earlier, the main downside risk to the Swiss economy is posed by the European credit crisis. Another risk factor, although not unique to the Swiss economy but to the global economic development, can be seen in the high prices for crude oil. And in the long term, risks for price stability can emerge from the current expansive monetary policy. Therefore, the SNB has to tighten this expensive monetary policy in time in order to prevent an increase in inflation.
Okay, thank you, Lena. We'll continue to monitor what's going on in the markets, and we'll also have build-up to the upcoming French election here on Dukascopy TV. But for now, goodbye.